The stock market has had a rough start to the year 2025, but here are two undervalued stocks that I am buying as the market is going down and I believe could outreturn the market by huge margin. The first company I bought is ASML. ASML is a Dutch company that designs and manufactures lithography systems. And lithography machines are basically machines that use lasers and light patterns in order to put the pattern onto a semiconductor silicone wafer. And ASML is the leading company in the lithography machine production line. And they're the only company to be making extreme ultraviolet lithography machines. So ASML has a pretty good moat, so this is why I am starting to buy into this stock. They have a very good competitive advantage, and they are the only company that makes these machines. Leading up to the AI boom and just all the chips that are going to be needing to be made, I believe ASML is in a very good position here to take advantage of the huge increase in demand for chips. And as we go over here, ASML stock year to date is down just about 4%, so it's definitely outperforming the stock market. I did buy this stock at about $620 per share just about a few weeks ago. I wish I did buy it under 600, but I decided to buy it at $620 per share. So my average price right now is about $620. If we go ahead and look at ASML's revenue, we can see very consistently growing, especially for such a consumer cyclical business. I believe this is some pretty consistent growth for the industry they are in. So pretty good growth, growing at about a 10 to 15% rate, so that's pretty fast. Now let's go ahead and look at the net income. Their net income also growing at a pretty good rate and slightly faster than their revenue, probably because their profit margins are increasing over time because of their competitive advantage in pricing that they can use for their machines. Now we're going to look at the shares outstanding. I want the shares outstanding to be decreasing over time. If the shares are being bought back by ASML, that means we'll own more of the company. And as we can see here, they're buying back their shares pretty consistently since 2014. And as we can see, they have been they bought back a lot in 2022 when the market had when we were in a bear market. So I wouldn't be surprised to see if in the next quarter they bought a bit more shares than they have over the past 2 or 3 years. So this is also very good. They are buying back shares, especially as we can see they were buying back shares at cheaper prices. So when it was at a lower price, it seems to be that they bought back a greater margin of shares. That means ASML has pretty good management and investing in a very good way and having a good opportunity cost. If we take a look at analyst expectations for ASML in the next 5 years, analysts are expecting ASML to grow at about a 19% EPS rate. So this is insanely fast, especially for the size of the company. And if they can sustain that, I think this is a great stock to buy right now. But let's go ahead and look at the intrinsic value I think ASML should be trading at. So for the first thing I'm going to do is the revenue growth rate. Since the analysts expected about a 19% earnings per share growth rate, I'm going to put this at 15%. Because I think they can grow at about a 15 or so percent rate, especially with the increase in demand for AI chips. But since analysts expected 19%, I'm going to put that a little bit lower to be on the safe side. Net profit margin. We can see it's been hovering around 27 to 28%, so let's put this at 28%, since it's been very consistent for ASML. Now, if I go ahead and look at the terminal PE ratio, over the past 10 years, it's been trading at about a 35 PE ratio, but it has decreased to a 27 PE ratio. So I'm going to put this at about a 23. I believe that ASML can trade at about a 23 PE ratio just because of the pure competitive advantage that they have. And they are the only ones making these lithography machines, so I think they deserve the premium. Now for the discount rate, I'm going to put 15%. Because I want to be making a greater margin compared to the stock market, which average about a 9 to 10%. So also I want to have a nice margin of safety in case my numbers are wrong. And as we can see here, I believe ASML's fair value price is about $825 per share. If they can execute on these numbers in the future, I think we could make about an 18% return if you bought today. So this is why I'm a big buyer of ASML right now. The second stock that I am buying right now is Adobe. Adobe stock has been trading down very sharply because of the AI boom and concerns over the business model that Adobe has, especially for Photoshop. due to the worry that AI could take over the business of Adobe. Also, because of all the other competitors, such as Canva, taking over some of the business of Adobe. But I do think that while I do think AI could destroy Adobe's business, I do think people will continue to use Adobe and continue to want a human control of Adobe. And I think if you wanted to Photoshop a picture, I think humans will still want to be able to Photoshop it in a way that they want. Because AI, yes, you can tell it what to do. You can't really necessarily go in and edit what they do to the picture. So I do think Adobe, while it will be slightly hurt from it, I do not think that it will be hurt as much as analysts expected. And as we can see here, Adobe is underperforming the stock market. It is down almost 16% year to date, and it's at about $370 per share right now. If we go ahead and look at Adobe's revenue, we can see very consistent increases in revenue, mainly because of their subscription model, and this is just very good revenue growth rate. While Adobe's revenue is increasing, it is starting to slightly decrease over time to a slower rate. And as we can see here, during the 2010s, they had about a 20% revenue growth rate. But in the 2020s, they have about a 10% growth rate. So while it is slowing, I still think this is a very, very consistent growth rate for Adobe, and it looks very good. And if we go ahead and look at the net income, we can see that they're also growing pretty good. While in the 2020s, they had a very stagnant earnings per share rate. In this past quarter, they've seen a huge increase in earnings. While hopefully they can break the trend of stagnant earnings growth for the 2020s, over the 2010 period, once again, they were growing insanely fast at almost 50% rates. Now they're starting to grow at about a 10% rate, so I'm pretty sure Adobe's margins have been slightly decreasing in the 2020s. While the revenue growth rate is consistent, we can see that in the earnings it is pretty stagnant. So now one of my favorite things about Adobe is the shares outstanding. As we can see, they are buying back shares insanely fast, especially as of late due to the stock dropping. Look at these buybacks by Adobe. This is just great to see, meaning we will own more of the company even if we don't buy any more shares. So as we can see, during the early 2010s, they slightly bought back shares, but in the 2020s, they're starting to buy back up to 4% of their shares. This means that we'll get an instant increase of our ownership by 4% if they're buying back shares. And especially, we want them to be buying back shares at a great time. And I believe this is a great time to be buying back shares for Adobe, just because of the low valuation Adobe has been trading at. As we can see right here, analysts expect Adobe to grow at about a 12% earnings rate for the next 5 years. So that's pretty good. I like to see about over 5%, which is a pretty good margin. But ideally, I want to see over 10%. So this looks pretty good for Adobe. While it's not as fast as ASML, I think this is still a pretty good rate. So now let's go ahead and value Adobe stock. First, I'm going to put in the revenue growth rate. Since analysts expected their earnings to grow at about a 12% rate, I think I'm going to put the revenue growth rate at 10% to be safe. Now net profit margin. I'm going to put the net profit margin at about, as we can see, while it is 31% last year, and over the past 5 years, 30%, we can see in 2020 it was 41%. So I think I might put this at about a 32% net profit margin. I think they can increase at a pretty fast rate, so I think this is a pretty good spot to have the net profit margin. Now, terminal PE ratio, I'm also going to leave this at a 23 PE ratio for Adobe, similar to ASML, because I still think they have a competitive advantage. Even though they've been trading down very, very much, I do think they still have this competitive advantage over other companies. And they don't just have Photoshop, they have many other things like Premiere Pro and Adobe Acrobat that Canva can't really compete with, or even AI. So I still think they have a decent moat in that area. And finally, the discount rate, we'll leave this at 15% since we want that margin of safety. And as we can see, I get a fair value price of Adobe at $364 per share. So right now, if you bought it today at $370, with these assumptions, I think you can make about a 15% return. So this is why I bought Adobe. I actually bought Adobe at $350 per share. If Adobe does get under this, and also with ASML, I will probably be adding slightly more. And over time, if it even goes down more, I'm going to keep buying these companies. So I think these companies are great buys as of today, and I think you will make a greater than 15% return on both of these stocks if you bought right now. And make sure you do your own research before buying any stock. Thank you guys for watching this video. Please subscribe, hit the like button. See ya.